certainly has been a winning trade for him. He's been bearish, and he's up double digits this year, Einhorn, on the simple idea of don't fight the Fed. But you still disagree with that, don't you?
Well, I mean, I think David's been right. It's been tough to fight the Fed. And, we've had a real tough time with our calls this year. But I think as we get into October, I don't think investors are fighting the Fed if they think stocks have upside from here. I think that's one of the big changes. And, some of it has to do with that some of the tail risks are coming off, like what happened in the UK. Part of it is that earnings delivery has actually been quite good. So, a bear thesis this year was that earnings were going to get crushed, and that still is going to be weakening, but the delivered earnings have been really good. And I think from a inflation perspective, I do think the Fed hasn't seen any effects. I think that's what we're hearing as a consistent message. But I think a couple of things have definitely changed when you really listen to what they're saying. The first is I think increasingly they are pointing to supply chains and commodities as really driving CPI, less attributable to labor markets. And that's an important distinction because that means the Fed can actually also get some help from the supply side easing. And I think we're seeing a lot of data, whether it's housing or used cars, that are really supporting that there's a payback coming where even though CPI still looks pretty strong, I think the Fed would be happy to see any type of weakening in inflation, and I think that's coming. So I just think the odds are very good for investors.
I don't know. I mean, those that have thought that inflation has peaked and that the Fed is going to be encouraged by recent signals have been dead wrong. Every time we have a Fed speaker come out and say, we're not there yet, inflation's not coming down enough, we've got a lot more work to do, we're going to go higher, we're not even in restrictive yet, just sort of smacking down that idea that they're looking to pause anytime soon.
Sarah, that's right. I don't think the Fed is saying, we're going to get a great number and we're going to pause. But I think the Fed is now laying groundwork for 2 pretty big hikes into year end, and then the possibility of taking a look around. And that's a huge change because if the Fed is potentially going to pause, it's not a pivot. It really changes how risk is positioned because investors wouldn't necessarily be short bonds, right? So interest rates don't necessarily have to keep going up. In fact, I think a lot of bond managers are making that observation now. And if interest rates plateau or start to come down at a time when there's almost record short positioning in equities, there's record put buying, record gamma on equity, put buying for gamma on equities, investor sentiment is record negative, that's a huge positioning off sides if the Fed is pausing. So, Sarah, you're right. I mean, it's like a Chicken Little question, but I think that this past week has actually really been in the bulls' favor.
Except for rates continue to climb. The 10-year yield is now at 4.2, and the 2-year yield right now is at 4.6%. Whenever we think we've reached peak, they continue to price in more. And I mentioned to Mike that the news today that the swaps market is pricing in as a 5% peak funds rate next year. That continues to make new highs as well. So as long as that's happening, isn't that going to stand in the way of any kind of stock rally?
And it's I think someone pointed out on Twitter the UK 10-year yield is actually below the US 10-year yield. I mean, if you were sort of thinking about that fundamentally, that almost doesn't make sense either. So I think, you do have to respect what rates are doing, which they're rising. But at the same time, rates are a reflection of risk premia and Fed policy. And again, it does come back to where economic data comes out. So I would just say that investors who think inflation is going to just keep powering higher, that's a possibility. But what's not really reflecting that is the soft data. And eventually, they do have to sync up. And again, it's been very tough to kind of forecast in economic data, especially inflation. But there's actually, I think, a much better appreciation that there are some things that are statistically lagging and flawed in CPI.
So your other point was earnings, and it does feel like, for the most part, earnings have been better. But I do wonder, Tom, always, how much is that expectations have been cut to the bone, and so the companies are coming out and beating. I guess it's good to see rational reactions. So when there's good numbers, AT&T, for instance, today goes up a lot, and on the flip side. But then, you get this Union Pacific today cutting its forecast for volume growth to reflect a challenging year. So it's not all good news.
Well, I mean, you should expect anybody who had pricing power or benefited from, the bullwhip effect should be slowing. But earnings are really a function of inflation, which affects top line and pricing. And that's going to be a tailwind for earnings. And then worker salaries, even though they've been rising, they've been growing slower than the real rate. So you have some margin expansion there. And if commodity prices, which as we know, haven't really been rising, I'd actually think we should be expecting earnings to deliver surprises, even though we are in the face of what should be a slowing economy.
Tom Lee, thank you for coming on. We appreciate it. Pushing
Thanks.
back against the negativity, as always. And by the way, the Dow has climbed back a lot just in the last few moments or so. Looks like we might have been about to go positive.